Okay, we'd like to call up our next moderator and panelists, please. What Adam Kent can do in 20 minutes is simply spectacular. And the slides will be available after the conference. But if that whets your appetite, please check in with Adam and members of the MSI team to learn more about that. Panel, come on up. Now to get a different perspective on where value exists today, Doug Mavrinac, who we met earlier, will lead the next discussion. Thanks, Doug. You can spread out a little if you want. It's a little cozy.
Thanks, Mike, and welcome again. Thank you again for everyone that is attending at this early part of the day, which is unusual, but I think it goes to the late start time. So for next year's purposes. Yeah, exactly. All right, so this panel, the first panel of the day, after Adam's presentation, the topic is where to allocate capital in 2025. And whenever I saw the panelists, I was like, this is going to be a fantastic panel because each of you guys come at this question from a different perspective and in different ways. So before we get started and addressing the topic, can each of you introduce yourselves and maybe say a little bit about your firms?
You want me to start? Yeah. Good morning, everyone. Nice to see so many of you here this morning. I'm actually used to going on panels towards the end of the conference, so this is actually quite a treat. Guess we're all refreshed and ready. So my name is Svein Engh. I'm with EnTrust Global. EnTrust Global is a firm that was formed by Greg Heimovitz back in 1997. Greg is actually in the house today. So he started this in 97. We got together back in 2015. And Greg had the interesting approach to the maritime industry that he thought the lending side was maybe more interesting than the private equity side. In other words, instead of buy low, sell high, get into the lending game because of a lack of capital due to the banking dislocation. So we got together, had a meeting of the minds, and decided to create a fund called Blue Ocean, which we launched with the first fundraise in 2017. So it's been 8 years now of track record in investing. The first fund we raised was about 215 million. And fast forward to today, we have now raised about 6 billion, and we've deployed more than that. So it's been an interesting ride. I think the whole thesis we had from day one around the banking dislocation has really played out for us. But what we did when we started this was to make sure that we had a very broad mandate, because when you're creating a fund like this, you really can't be pigeonholed into just doing one thing, because it's all about growth. So we decided to structure something which had a very broad mandate, not only in terms of the sectors across all of the ocean industries, but also in terms of the capital structure. So we can do anything from senior secured debt to common equity. Now, that being said, we are more focused on the lending side, and typically we will do 70 to 80% debt, and the rest will be typically equity. And that model has really turned out to work out well, so we can play along the different sectors and also along the capital structure. And I think the results have been very good so far. This broad approach, I think, is really what's helping us grow the business. Also, we decided day one that we wanted to build this from the ground up. We wanted to have a dedicated team and a dedicated fund. And today, unlike in the early days, it was just Greg and I, and we added 2 people, Omer Donnerstein, who's my partner, and Carrie Schweitzer. Today, we're 27 people globally, a dedicated team. This is all we do. And we're very fortunate to be part of EnTrust Global, which has all the other pieces that you need, such as compliance, accounting, and so on. So it's worked out really, really well for us. I know there was a bit of a long intro.
That's fantastic.
Yeah.
Thank you.
Thank you.
So, Constantin, I mean, you were wearing 2 hats. So maybe a little bit about yourself and the 2 hats that you wear.
Yes, absolutely. Good morning from my side. Constantin Baack. I'm CEO of MPC Capital. We are an investment and asset manager focusing on maritime and energy infrastructure. We have around 300 people in 10 different offices, working in maritime services, setting up investment structures, and basically building companies in the space. And I'm at the same time also CEO of MPC Container Ships. That is a container tonnage provider. We have a focus on vessels that operate on intra-regional trades, so everything between 1 and, let's say, 8,000 TEU. We own around 60 ships, and we operate them globally as a tonnage provider to our customers.
Fantastic, thanks. And Matt and Mike, by the way, he's got the Merry Money swag socks on. So anyhow, Nicolas?
Yeah. Hi, I'm Nicolas Tirogalas. I'm the group president and CIO of Tufton. Tufton is similarly to MPC Capital, an investment manager that invests exclusively in shipping and offshore. We've been doing that since 1985. The firm was founded there. We have 4 different offices at the moment, mainly in Europe and the Middle East. And we are running public and private money, so 2 public companies, one in London under the ticker SHIP, one in Norway. The one in London has a diversified fleet of tankers, bulkers, gas carriers today. It used to have some container ships that we sold out. We effectively use third-party technical managers, so our mandate is really to make similar decisions like ship owners when to buy, to sell, and commercial strategies, but we don't actually do the operations ourselves. Second public company is Stainless Tankers. It's a pure play on the Norwegian market, invests in chemical carriers, and effectively since March of this year, we completed a management buyout by the team that runs the firm, whereas we had a German family office that was invested and had a significant stake in the general partner. We're firm believers that the people that run the money should be the people that also are responsible for running the firm as well. And we've seen that to be a successful strategy over the longest period that we have been doing this. And effectively, we're pursuing now corporate transactions, a little bit going back to our roots of looking at debt funding as well. And on some of the topics I'm sure we're going to discuss, we like and believe in the energy transition, and we want to be part of it too.
Yeah, we'll discuss it. Ted?
I'm Ted Young with Dorian LPG. We have the most boring business compared to the guys up here. We don't invest in multiple asset classes. We do one thing. We ship propane and butane on big ships, VLGCs, and that's kind of all we do. And it's worked pretty well.
And you do it well. You do it well. Harris?
Thank you, Doug. Good morning, everyone. My name is Harris Antoniou. I'm the founder and managing director of Neptune Maritime Leasing. And we do exactly what the name of the company says. We do maritime leasing. We set up the company 4 years ago with a view to provide security, affordability, and environment as a service to our clients. And in fact, we've managed to grow pretty rapidly. Actually, I looked at the compounded rate the other day. It was more than 150% per year. Of course, it's easy when you start small. But we've grown to more than $250 million worth of leases and a fleet of more than 40 ships at the moment. And we're looking forward to do more across the different maritime segments and continue to service our clients.
Fantastic. Thank you, everyone. And for those of you in the audience that didn't know who these guys were or where they came from, now you can probably better appreciate why I was excited to hear from each of their different perspectives. So digging in, and we'll jump around a little bit. Svein, we did a panel together last year at the Marine Money Conference, and you guys have remained quite active since last year up until now across a variety of business lines, supplementing and complementing your already diverse asset ownership. Can you discuss EnTrust's capital allocation strategies and how they have impacted some of your recent investment decisions? Because you guys have closed OMP, Bell Ships, et cetera. So how have your capital strategies impacted your decisions and how you pursued those two in particular?
Yeah, so we really have just one overriding principle with everything we do. As I mentioned, we have a broad approach when it comes to sectors and also the capital. Most of what we do, which you don't really hear about, is our lending business. What we do every week, provide debt capital to owners, operators around the world. As I mentioned, that's the vast majority of what we do. That's about 75% currently of all the capital that we have deployed. So even though we made some platform investments, the last one being Bell Ships, which we took private a couple of months ago, is really the lending. That's the bread and butter of what we do. But because of our mandate, we have the ability to do other things, and then it's all about timing, always keeping in mind the cyclical nature of this industry. If there's one thing I've learned after 38 years, it's the cyclical nature, and it's incredibly important as an investor that you always have that in mind. So we do have a kind of cyclical approach. OMP, which I think I briefly touched upon last year, was very complementary to us, a very strong team based in Oslo, and also a lot of LNG exposure, which we actually didn't have at the time because we had not really bothered to compete with the banks. So that came with a very good portfolio. The Bell Ships transaction was a little bit unusual for us. It's the first time we've done a take-private deal, but there were a lot of different factors there that were very attractive to us. Of course, the fleet, number one, it's very, very high quality, virtually brand new fleet, and quality management, and also a commercial management platform that we were very excited about. That came with the acquisition, but also an important factor was the Japanese financing structures around the whole fleet, which is something that really appealed to us because of the optionality embedded in those structures. So a number of different reasons, but most importantly, we're able to buy it at a discount, which obviously is very, very important.
Okay, thank you, Svein. And so, Nicolas, similar question to you. I mean, we talked about all the uncertainties in the world right now and challenges that deploying capital entails at the moment. From your perspective, where are you finding some of the most interesting areas to deploy capital, either geographically or from a sector standpoint? And how does Tufton's, you mentioned energy transition a bit ago, how does your energy transition focus impact your views?
So around energy transition, what we have seen compared to last year that we were here, for example, I mean, ESG still remains in the people's mind, but perhaps with a different focus. People are less willing to take the same risk that they were willing to take last year. And what we have seen is, and what we pursue is deals that have long-term cash flows, contracted cash flows. Obviously, they have a lower yield and potential IRRs, but at least they allow you to participate in the energy transition while at the same time you do so with a better risk, downside risk protection. When it comes to assets, I mean, geographies, obviously, what we have seen more recently is tanker values have, especially on the older side, finally started to come off a little bit. Which has made a lot of the smart money, the owner's money, go after them. We've been spending a lot of time on looking at similar opportunities in the what would be considered post sort of 12 years, 15 years, and you can potentially realize higher returns if you're willing to take a little bit more risk. Because the charter rates are still holding up, asset values are starting to come off a little bit, and that at least in our book makes, in addition to containership that has always had at least 18 months really good yields and attractive opportunities, tankers seem to be getting there on the older end. Dry bulk are still dogs.
Gotcha. Thank you. And Harris, from a credit lending standpoint and a geopolitical standpoint, we've got lenders coming back to the market in the Middle East. We've got Greek banks gaining share, all that sort of stuff happening. And we've also got some owners previously financed by Chinese leasing companies exploring potential refinancings. Given all of that, all of those factors, what does the runway for lending opportunities look like for you guys? And where do you see value from a capital deployment standpoint?
We started the company, as I mentioned earlier, 4 years ago, and we took a two-stage approach in capital allocation. First, we said, what is the best risk-reward position to have in shipping at that time? And the answer to that, in our eyes, was to set up a leasing company, because, of course, it provides to our investors, certainty and predictability of earnings, going forward, and it also provides a portfolio diversification that you don't have when you invest in particular segments otherwise. And the second layer of analysis was, where do you put the money once you decide to actually do a leasing strategy? And there we are being counter-cyclical, in a sense, because the majority of the banking system, because of regulation, is forced to actually, in fact, act pro-cyclically. And that means that when you actually need support as an owner, that's where it's mostly difficult to get. So we thought, okay, let's just, and having experience as bankers as well, we decided that we're going to do counter-cyclical approach. One example of that is that although we started with bulk carriers and container ships, we quickly pivoted to the offshore business, and we did quite a lot of PSVs, both second-hand and new buildings in different geographies, because we thought that that's where the best value could be found. And when it comes to the first part of your question, I said earlier we focused on security, affordability, and the environment. A lot of the focus at the beginning of perhaps the decade was on the environment, and rightly so, by the way. The only difference being that we had a very different interest rate environment, which allowed people to make bolder decisions and investments, which probably at the time made sense. Now the focus is completely changed. Geopolitics, of course, have taken a completely different direction, and that makes people focusing mostly first on security and then on affordability and the environment. So as a European container shipping leasing company, we are able to offer this security and predictability in funding. And of course, we have set up Neptune Leasing as a company, not as a fund, which means we have a longevity in the way we look at the market. And that allows us to be able to use our balance sheet, attract better funding rates that we're able to pass on to our clients. So we've been able to develop a very competitive product. And last but not least, if I may say, focusing on the environment, we've been very strong in our thesis that although a large part of the new buildings, of course, come with electronic engines and much better efficiency, 50%, almost 50% of the fleet by next year is going to be at D or E categories when it comes to CII. And what are we going to do with those ships? So we're a very strong proponent of retrofits, and we work together with our clients to help them, in fact, increase the lifespan of existing vessels, because that's the only way to continue servicing the world trade. Thank you.
Thank you, Harris. Ted, it's going to be a little bit different for you because, as you mentioned, a lot of these guys can go across sectors. But as a public company CFO focused primarily on the LPG sector, how do you think about Dorian's capital allocation strategy in the current environment? I mean, you got a ton of cash, plenty of firepower to pursue opportunities if attractive. You've also got firm VLGC rates, put you guys in a great spot. How do you think about deploying capital in the current environment?
Very carefully. No, we, look, I think our job, and it's interesting, right? For the guys who are more on the private side, ultimately you're driven by IRRs. And I'd say as public company, we are driven by total shareholder return. And so that sort of governs our overall thinking. And, when we look at how investors sort of evaluate your potential for total shareholder return, we know return on invested capital is really important, return on equity is fairly important, and of course, what you do with your free cash flow is important. So from our perspective, looking at those various levers, look, we are currently, 20-25% spot. In the fixed 80% spot. And that's worked out pretty well, but we have a balance sheet that allows us to do that. So, our break-evens are such that and our cash balances are such that we can sort of handle whatever may come. Nonetheless, we know that it's important that we generate good returns through the cycle, and we've been able to demonstrate that over time. How have we done that? I'd say one, like everybody in shipping knows, you got to get the buy right. And thus far, we haven't gotten that wrong. We've probably gotten it a lot more right than wrong. That's been good. We've been smart, I think, about how we funded ourselves. We didn't load up too much on debt early on in our existence, which allowed us to pay things down. We're pretty big sticklers on the terms in our loan agreement, not just the margin, because there can be a lot of tripwires, and that saved us some heartache along the way. And we've got developed a diversified funding base. So we work with the Western European banks. We work in Japan in the Shintoku market predominantly. But all of that leads to hopefully over time a lower cost of equity. So what do we do then with the excess cash? We have experimented with really sort of open market repurchases. We did a self-tender offer and dividends. And we, at least empirically, what we've seen is the best way to generate noticeable total shareholder return is really through dividends, because even though the finance books would tell us that a dividend and a buyback are effectively the same, I think our experience, at least in our sector, has been that is most certainly not the case. And I think part of it has to do with the inherent volatility, certainly in our sector, but in other sectors of shipping. From our perspective, giving a shareholder $1 to do what he or she wants with it is far better than sort of implicitly forcing them to decide to buy or sell. And as we look at our returns over the last several years, we've really seen a huge benefit from paying out those dividends. We haven't gone whole hog on paying out everything because, as the other panelists have talked about, the next generation of propulsion is a big deal. ESG, or at least the E, is extremely important. And so, we want to maintain the flexibility to evaluate those technologies. We've made a couple small investments in more venture-y things where, one has to do with alternative fuels, another has to do with carbon capture, small-scale carbon capture. And we've even made a small investment in a crewing platform, because that's also probably something that I think a lot of us know is looming on the horizon as a potential problem, because younger people are less interested in going to sea, making a career of it. So having access to good crew in the future is also critical. So kind of looking at all those things together, we're driven by total shareholder return. We want to get the capital investments right. We want to minimize the risk for our investors to keep our cost of equity low. And we want to be as well positioned as possible for all the future developments. And that's kind of how we go about doing it.
Fantastic. Thank you, Ted. And then Constantin, last but not least, and I saved the last spot for you because you have the two hats, so you'll probably take a little bit of time. But in the current environment, you got MPC Capital, MPC Container Ships. How do you think about that question of deploying capital, where opportunities available on both sides? The capital side first, maybe, and then the container ship side second.
Well, in the current market, it's obviously not easy, and I think that came across. There are always opportunities. And as MPC Capital, we are looking at all sectors. We have over the last few years done mostly containers, because I think that's where the value at least was, in our view, easier to monetize, and where also the risk-return profile was attractive. We have also entered into some new sectors in the offshore wind space, but not, I would say, the conventional CSOV track. We have developed a design together with partners for a, let's say, new niche in the offshore wind market. The jury is still out whether that was the right approach, but we do believe investing in structural growth markets is certainly something of interest if you have the right assets, the right partners, and the right approach. If we then look at the container side and MPC Container Ships as a listed company, we have basically used the last couple of years to do a few things. Firstly, optimize the balance sheet, because we obviously had the best container market in history. So we have really ensured that we now have a very good volume of investment capacity at hand in order to move forward when the time is right. And I'm not saying the time is right today, but I'm saying you need to be ready. So optionality and flexibility in the balance sheet is extremely important. What have we invested in, and what do I believe we will invest in going forward? It's fleet renewal. When we started in 2017-18, we had an average age of our fleet of around 15 years. Now, 8 years later, we're at around 14 years. So, and we have paid $1 billion in dividends in between. So it's really about doing the right thing at the right point in time. You never hit the nail completely on the head, but be also rewarding to investors when you generate a lot of capital, but don't overdo it. I mean, $1 billion in dividends in 4 years is massive. We have just recently reduced our dividend policy slightly because we do believe going forward it's about maintaining optionality and flexibility in the balance sheet. And one thing that we have done over the last couple of years is, last 3 years we bought roughly 30 ships and we sold around 40. And we sold the vessels that we deemed as not being fit, even in a retrofit case, to have a future-proof fleet. And we rather bought younger vessels. And very importantly, we have invested into our fleet. We have done around 25 retrofits, substantial retrofits, always hand in glove with our chartering partners on the container side, who have either provided long-term, in my size of container ships, that's 2 to 3 years, so longer-term time charters, have participated in the CapEx, and hence we have been able to generate very, very good returns on the capital that we have out there. So going forward, fleet renewal is still on the agenda in the container market. I do believe, and who watched Adam's presentation earlier saw that if you look at asset prices and charter rates, the best de-risking you can get is still in the container sector on a secured cash flow basis. You have very good counterparties. You just need to find the right deal, and that's not always easy. Ordering on speculation is obviously risky in a high, let's say, new building price environment. But combining cash flows with asset prices in containers is definitely something that I see for the next 6 to 12 months as being an attractive path going forward.
Fantastic, thank you all. And we have a handful of minutes left, so I was hoping I thought a couple questions to the group and just tackle them as you see fit. But I wanted to tack on to something, Constantin, that you just mentioned, and I mentioned in my comments as well. From a banking perspective, I mean, transaction activity has really slowed down over the last few months. It started off the year with a bang, working on a lot of things, activity has slowed. Clearly, people are positioning themselves right now. I mean, conversations are nearly nonstop all day long. How important is timing? How willing are you guys willing to lean in, given the current environment? Or do you think it's time to get positioned, maintain optionality, such that whenever we do get better certainty, whether it's tariffs, whether it's conflict, whether it's a Fed that's going to be a little bit more accommodating, how much does that weigh in, this timing weigh into your decision making in terms of leaning in versus just saying, hey, let's wait, let's get ready, but let's not pull the trigger just yet? Maybe Svein?
Yeah, I mean, we really started this business on the back of banks pulling back. So obviously, what you just said, your first part of that statement was, is music to our ears, because as the banks become more careful, we get more opportunities. So we actually welcome that. At the same time, though, we obviously need to be aware of everything that's going on. So this is a time when you have to be careful not to make mistakes. So a lot of due diligence and vetting goes into everything that we do. But as a good example, the last couple of years, we really got into the offshore sector, which we hadn't done anything in prior to the war breaking out in the Ukraine. And that was an area where the banks were literally not doing anything. So it was a great space to get into at the time when the market was starting to move again. And we were able to deploy a lot of capital in that sector because of a lack of competition. So that's sort of our approach, but obviously it's a very, very unusual time right now. So we have to be very careful not to make mistakes at the same time. So right now we're actually more focused on the debt side. There's not a lot of, I think, interesting deals on the equity side that we see at the moment. So we're more focused on the debt side right now.
I think discipline is key in what we do, obviously. And not doing a deal is probably sometimes the best decision that one makes. So, for us, we like teamwork. We like to do things with partners that are complementary. We're looking at a lot of things with other partners as well. But, the point that Constantin was making about sort of sitting on the sidelines and waiting for the right opportunity is, in shipping is not easy, but it's very important to do so.
Right. Ted?
Yeah, I'd say I echo what everybody's saying. I think one of the things I learned through the years is in shipping, you got to make your mistakes small. So if you're going to go in, whatever your timing is, usually you're not going to be 100% right. So you better hedge your bets somehow, some way. And I think when I look at our sector, I'm certainly not going to say the tariffs don't have an impact. They do. They affect a lot of things, some positively, some a little bit negatively. But the fundamentals in our business I still really like. And so I think that would continue to guide. Guide our investment decision. I'm not going to ignore the next few years, and you'd have to capitalize and buy on that basis. But on the other hand, for us in our little LPG world, we continue to like the fundamentals, the pull-through demand, the growth in production. So that's probably more important in terms of making an investment decision for us than it is trying to handicap, what the president's going to do next week.
Right. Yeah. And you can never undo a bad buy, right? You're stuck.
And maybe one addition. I think the way we approach this, we do what we can control, right? And that's have your balance sheet ready, have capital available, and not necessarily rushing into anything because you feel like you should, right? It's really about sitting on the fence, but the opportunities in shipping, there are always opportunities. I'm not at all concerned about not having an opportunity, even if you miss one, but to do the wrong thing at the wrong time, that might break your neck. And therefore having optionality in your balance sheet, being able to move, and opportunities will come in any case.
Yep. Harrison, see, leaning in.
As they say in shipping, you need to stay solvent until you get lucky. So that's a secret to success, I suppose. But we stayed away from this because we've created a buffer between what we do and where we invest in, and the actual market volatility. As we're not taking equity positions, we're a lessor. We're taking a debt position, and I think in the next few months, maybe a year or two, I think that's where we're going to keep our focus on. And one more thing to say is that it's very pleasing to see that shipping is actually growing in the position where it needs to be from a global perspective. A lot of governments, the local administration here in Europe, they realize that actually somebody needs to make the investments that are necessary to keep the shipping industry functioning and operating, and at the same time reducing the emissions and helping the environment. So we're going to see a lot of investments going into that. There's 150 billion approximately every year now. It's going to grow to more than 200 in the next 4 or 5 years. So there's great environment to be operating in.
Yeah, fantastic. And guys, that does us for time. So thank you all very much for your thoughts and your insights. Thank you.
Thank you.